Hi, dividend growth stock investors. You know me by now. It is Colby, the DGI Crab. Where are the bargains? Where are the bargain buys in this stock market that is on fire all through 2024? It's just getting harder and harder to find bargains in the stock market. And some of you might be getting tired of me every Friday talking about how I'm purchasing the same small little cluster of stocks because they're some of the few that look like they are trading on sale. So a while back, I did a four-part video series called The Bubble Stocks. I'm going to link that playlist in the description below. What are those? Those are 40 high quality dividend growth stocks that came close to making my list of the top 60 that this channel specifically focuses on. But for one reason or another, they just didn't quite make the final cut when I was narrowing that list down. So what I thought I'd do today is check in on the 40 bubble stocks, just like I do with the main 60. I've broken those down into four separate tiers based on the age of the investor that should be focusing on them, because my opinion remains your age and time horizon is the most important metric when you are making the leap into becoming a dividend growth stock investor. So I put the bubble stocks together on the spreadsheet, just like I do with the main 60 that we cover every Friday. It's not Friday yet, it's just Thursday. So I thought, let's see how these bubble stocks are doing and see if we can find better value from them. None of this is financial advice. I'm not a professional financial advisor. Do your own due diligence when you are investing. So here's the bubble stocks for tier 1 for the 18 to 30-year-old investor, super compounders at lower yields. I got nothing here, you guys. Every single stock in this particular list, all 7 of them, are not only trading or yielding below their 4-year average. They're all in this red zone here. Some of them are remarkably overpriced. Apple being the primary one. Now I get it, stocks like Apple generally aren't going to be trading cheap. And when you've got really high quality stocks, you're going to have to really be specific about when you're buying them because they're more inherently risky than just dollar cost averaging into ETFs. So when I'm trying to purchase an individual single stock, I want that valuation metric, which is comparing the 4-year average yield to the current day yield, to be a solid 30% above. I want a 30% higher yield when I buy the stock than it's averaged over the last 4 years. That's on sale to me. None of these are even 5%, and only Service Corporation International, the largest funeral home and funeral services provider in the country, it's why I like this one, they're all trading below that right now. So I'm not seeing anything here. eBay looks overpriced. MasterCard looks a little overpriced. Lincoln Electric, L3 Harris, Williams Sonoma. I'm not seeing a single bargain on this one. How about for tier 2, the 31 to 41-year-old investor, where we're getting a little bit higher yield, but not sacrificing our growth rate all that much? Well, American Water Works Company, largest water utility in the United States. That one's not a terrible deal, just under 25% undervalued for your average yield of 1.74%. You can buy it right now at a 2.17% yield. Not a terrible deal, but not anything that I'm doing cartwheels to my apps trying to get a hold of them. Comcast, also not a terrible deal for your average yield of 2.46%, currently yielding just a shade below 3%. But, nothing here that's hit that 30% undervalued mark in either of the first 2 tiers just yet. Bank of the Ozark, a smaller regional bank stock that I do really like a lot, they do dividend increases every single quarter, and they just came out with another one. It was like 2%, something like that. Cumulatively, their increases are usually like 9 to 11% a year in total. Even with their recent small dividend increase, they're still sitting here just yielding a little bit higher, just 12% higher than they typically do. So I'm not seeing any screaming buys here on this one, unless you're really into water utilities. You could probably do worse than American Waterworks Company right now, but not anything I'm particularly excited about. Tier 3 for the 42 to 53-year-old investors, where we're looking for 3 to 4% cumulative starting yield and a growth rate of 5 to 8% a year. UGI Corporation has really had a hard go of it these last couple of years, and their 4-year average yield has just continued to go up and up and up week in and week out. About a year ago, this was a stock where the 4-year average was like in the lower threes, like 3.2 or 3.3. It's gone all the way up to 4.44 because they just can't get out of the basement. They're currently yielding above 6%. This is an interesting one to check out. They've got a long history of increasing dividends. Their payout ratio is still very manageable, right around 50%. And you can get a nice high starting yield, but they've been down for so long, they almost make me nervous. I don't know when the recovery happens for this company. Prologis, very large REIT. Believe this is the largest REIT by market cap in the United States. They're starting to look like they're trading at a pretty decent valuation right now. 4-year average of 244, currently yielding 313. But with REITs, those are not tax advantaged dividends. Those dividends are going to be taxed as ordinary income. So I really want to get a good deal if I'm adding REITs, especially to a brokerage. If I was going to add Prologis at these prices right now, I'd probably be doing it in my Roth IRA to get the tax advantages. And then, we got another water company here, Essential Utilities, another company with a nice long track record of increasing dividends year over year. And another water company, SJW Group, a dividend king, very long track record of increasing dividends. They're trading at respectable prices right now. But again, I'm not more excited to buy these than I am the stocks in tier 3 on my main list, like Hormel Foods, Archer Daniels Midland. So I'm not going to compromise value in that case in order to reach down here and get some utilities that look like they might be a better deal. I just want to focus on those blue chip companies. And if I can't get them at that 30% off mark, then guess what? I'm going to put more money into ETFs and just get the diversification and not worry about taking risks on companies that might just not have a recovery coming. For tier 4, the 54 and older investors, I do have 3 stocks here in the green. Now, the 54 and older category on my Friday video, I haven't had anything in the green since the beginning of the channel. I've had some things in that yellow range, 20 to 29.9% undervalued, but everything's been in the red, just hold area for the 54 and ups for a while now. But let's look at the stocks that we have here in this category. We've got Franklin Resources, stock ticker BEN. They've been down and out here for a little while. I think that this is a company, there's a possibility I could see Franklin Resources eventually getting acquired by a larger company like a BlackRock or something like that. That may not happen. That's just total speculation on my part, you guys. But Franklin Resources just way down. 4-year average yield of 4.4%. You can get them right now yielding 6%. Payout ratio is respectable. I mean, I think that dividend is pretty safe, but I don't know. This is like UGI in tier 3. It's just been down for a really long time, so it just makes me a little bit leery about how big of a recovery they've got. Pfizer, I mean, everybody knows Pfizer at this point in time. They're yielding a lot higher than their 4-year average. They haven't cut their dividend in 30 plus years, but man, that payout ratio of above 100% just makes me think that a dividend cut could be coming in the near future. I certainly don't expect much of an increase to that dividend. Could be wrong. They've surprised me before, but I don't know. This is a major red flag for me on Pfizer. One of the main reasons they didn't make the top 60 stocks, because I was concerned that there could be a dividend cut coming. Now, I do like this REIT here, Alexandria Estate Equities, stock ticker ARE, 4-year average yield of 3.26. It's more than a full percent higher here, 4.29% current yield. Again, it's a REIT, so you do have to think about the added tax implications for the real estate stocks. But I mean, this one doesn't look too bad. You can get a 4.29 starting yield, and they've got a pretty nice history going of increasing their dividend by like 5-6% a year. Pretty solid, pretty solid. If you can get 4.29 current yield and then get 5 to 6% increases annually year over year. Their price to AFFO ratio below 70% makes me think that they're not going to have any trouble continuing to do steady dividend increases. And then a lot of the rest of this stuff, just not great deals here. Mid-America Apartment Communities, another good solid REIT that I definitely like a lot. They were a better deal earlier this year than they are now. A lot of the REITs have recovered since the Fed started cutting interest rates. And I'm just not seeing a ton here that gets me excited. I mean, you've got some good stocks here. LyondellBasell, Black Hills Corporation, another boring but stable dividend king. Vici Properties, everyone loves this REIT, but the time to get it on sale seems to have passed. So once again, there is just not much here that gets me particularly excited. There's not anything here that I want to replace one of the main 60 stocks that I cover on the channel. So I just wanted you all to know, I get that this channel focuses on those 60 stocks. I am, however, paying attention to the rest of the market because I do want to be ready to pull the trigger in case I have to remove one of those 60 at some point. What could cause me to do that? A dividend cut would cause me to do that. And I'd be looking, first place I would go to is my bubble stocks here and see if there was something sitting here that looked really appealing to me that I thought deserved to be in that 60 more than one that did a dividend cut. But hey, so far so good. None of them have cut their dividends. They keep increasing their dividends. That's why they're in the top 60. These 40 stocks that I've shown you here today are all fine companies. I wouldn't turn my nose up at you if you had any of these 40 stocks in your portfolio, so long as you were doing so in an age-appropriate way. So basically what I mean by that is like Black Hills Energy, nice stock to have if you're a current income seeker and you just need some steady yield that's going to gradually increase year over year. If you were 21 years old, then I'd probably tell you this is not a stock that I would hold at that age. I'd be trying to look at something that had a stronger compounding, higher dividend growth rate than what you're going to get from an old established utility here. So that's the list of the 40, you guys. If you own any of these, again, like I said, I no judgments here. I think that they're all fine choices, but it's not like there's a ton of value to be found here either. We've got 3 in the buy zone in tier 4, 1 in tier 3, none in tier 2, and absolutely none in tier 1. So I'm going to stick to those 60 stocks that the channel primarily focuses on. I think that I've really done a lot of work getting that narrowed down to a manageable list of stocks and breaking those down into 4 separate categories so they're very manageable for you based on your age and your time horizon. So just be patient, everybody. If there's not a good deal to be had, I think it's a terrible idea to just jump into a stock when it looks like it's overvalued, because that just means that if and when a correction occurs, whether it be that company or just in the stock market in general, they always were going to happen at some point. That just means to me that stock has a lot further to fall and go down than one that's already kind of down, like a Nike or a Hershey or an Archer Daniels Midland. How much more can those crash if the stock market takes a major downturn in the next 6 to 8 months? They could definitely go down even more, but are they going to go down as much as some of these that are just way overpriced? I don't know. At least I don't think that that's very likely. I think that a lot of the stuff that I focus on putting my new money in is already down quite a bit and has a lot more room to grow and recover than the stuff that's already appearing to peak. So that's how I feel about it, everybody. Let me know what you think. Links to the videos in the description below, including a link to the Bubble Stocks playlist. You can go check it out and see how I came up with these 40 and why they didn't quite make the cut. Email me your questions at dgicrab@yahoo.com, and I will catch you on the next one.